Welcome back to Forex Professional Training in Financial Markets. In this session, option, binary option, and the differences between them will be studied thoroughly. Option, binary option, and the differences between them. Option is a defined contract between a trader and a company that provides trading services, in which a trader buys an underlying asset voluntarily, to buy or sell that asset at a particular price or after a specified amount of time. Considering that there is no preset price of sell and buy for a trader until the expiry date of the contract, there is no definite profit on that contract. The amount of profit goes up if the asset has reached its desired price before the expiry date and the trend is continuing its direction. The contract is defined by strict terms and conditions. Call and put options. Options can be categorized into two types, call and put. Purchasing a call option represents that the trader expects the asset price to increase before an appointed time. On the contrary, if the trader supposes that the price of the asset in question will decline within a certain period of time, he or she buys a put option on that certain asset. If the price of the purchased asset crosses the strike price, or the price exercised in the contract, at the end of the expiry date, then the trader will gain profit. Otherwise, the premium paid by the trader will be lost. Comparing with trading in Forex market, purchasing a call is like buying, whereas purchasing a put is the same as selling. Associated with the market, there are four types of attendants based on their engaged position: buyers of calls and sellers of calls, buyers of puts and sellers of puts. People who purchase call or put are called holders, and those who sell call or put are called writers. Call or put buyer or holder is not obliged to purchase call or put. However, call or put seller or writer must sell call or put and must make a promise to buy or sell. Unlike trading in Forex brokers, there is no leverage represented by option and binary option providers. Hence, the risk of losing a huge chunk of your money in an option contract is lower than a trade on a pair in Forex market. Binary option. Binary option is a type of option which has the same definitions such as premium, strike price and expiry date. The difference between option and binary option is the contract premium that is chosen by the trader in addition to the shorter expiration time frame. Numerous binary option providers are represented through binary options section of our website. Ample reviews including their regulation, payment method, supporting language, alongside their advantages, are all described for your convenience. Here are the differences between option and binary option. Expiration time. Binary option can present short-term contract period, such as a 1-hour expiration period. Traders can make instant profit with more available time frames and more flexible investment selections. While time expiration of option can be weekly, monthly, or even longer, time expiration of binary option can be less than a minute to a few days. For instance, 24 option is one of the most famous binary option providers. It represents contracts with less than 1 minute expiration time. This is beneficial and favourable for traders with a fast trading manner. Payout. The binary option provides payout at a percentage of the premium chosen by a trader if all the conditions of the contract are met. The price of the asset stands on or crosses the target price at the expiry time. This indicates that a trader achieves fixed amount of profit even if the price passes the target price considerably. Contract termination. Unlike option trades, in a binary option, a trader must stick with the contract until the expiration time. Hence, binary option requires careful consideration and regard. Some binary option providers allow their traders to extend the expiration time, rollover option. Also, others permit their traders to close the winning positions prior to the expiration time to cut the assured profit. Now let's check the examples of how option and binary option work. Binary profit and loss calculation. On the 21st of February, a stock price of a company was $115 and the premium was $8 for the 11th of April with a strike price of $124. This indicates that expiration date is the 11th of April and the total price of the contract is $2 times $100, which equals $200. Remember that the stock option contract is to buy 100 shares. The $124 strike price shows that if the stock price is less than $124, your call option is worthless. Considering the premium you paid of $200, you are already losing $200. Until the 2nd of April, stock price reaches $128.54. Your profit is calculated this way: 128.54 minus 124 equals $4.54. You then multiply this by 100, which equals $454. Now minus the $200 you initially spent, and you're left with $254. This shows that until the 2nd of April, your profit is $254. On the 11th of April, the stock price of a company declines to $109.99. Then the contract expired at the end of the 11th of April. Eventually, profit made by the 2nd of April has vanished, and you lose the premium you paid on this contract of $200. Binary options profit and loss calculation. The procedure of profit calculation in binary option is quite different. For instance, you want to trade on a pair, US dollar against Swiss franc, which has a rate of 0.9644. You predict that the rate will go up until next week. By checking the binary option provider platform, and you see the payout on a one-day contract for purchasing call on this pair with current strike price 0.9644 is 85%. Selecting a $200 premium and the contract on this pair with a specified amount of premium, expiration time and target price are completed. If the price of the expiration time, 1 day, rises above the strike price, you'll gain profit. $200 multiplied by 85% equals $170, in addition to the premium that you have paid, $200. On the other hand, if the price falls under 0.9644 or the strike price, your loss will be limited to the premium. Full versus zero fruit. At the end of the contract you dealt, the commission section shows your revenue. Profit. If market trends and price movements meet the contract conditions you predicted, you achieve the profit dealt with the provider alongside retrieving the premium deducted from your account fund. Loss. A zero volume indicates that you have lost the deal, and the premium, which was deducted from your account fund, is taken as compensation for your loss. That concludes this session. Until next time and another session, take care.